All right, everyone. The next section that we're going to cover is called personal accounting and managing income. Uh, we're going to go through a couple things. One is what personal accounting, and we're talking about the balance sheet and the income statement, some of those things. And then we're going to talk about managing income, and we'll get started on your first project. The next section we'll also cover in this week's section is expenses, and I believe that's it for this week. So these again are the two sections: managing income, personal accounting, and managing income, and then we'll have a dedicated section just to expenses. And here we go. So the first thing that we're going to look at, and before I forget, you may notice that my voice, as this is recording, is delayed from what you're seeing on the screen. I have a voice plug-in type deal that it smooths out the recording of the voice. So I'm going to be using that. So you may not want to focus on me at all. Otherwise, you might get a little screwed up. So, all right, the first thing that we need to look at in personal accounting is these the two financial statements that we look at. And the first one is the income statement. And the income statement is a little like, we can use an analogy of a basketball team. And the income statement is like looking at the performance of a basketball team. So if you're thinking about a basketball team and you were trying to analyze how they're performing, you might look at things like how many shots they're making versus how many they're not. You may look at the score of the other team and those types of things. And similar to that, that's what we're doing when we look at this thing called an income statement. And on an income statement, we see two things. The first is the income. In a business context, that would be the revenue coming in. And that's an amount of money received over a period of time, either as payment for works, goods, or services. The next thing that we see on the income statement is underneath it is expenses. And that's the amount of money that's spent for goods and services, and they're usually defined as fixed or variable. A fixed expense would be something like a mortgage payment or a cable bill. Those are fixed amounts that come out every month, and you plan for them to be the same every month. An example of a variable expense for most of us might be food or an electricity bill, where some months you use more electricity than others. So again, we look at this income statement, and once you take your income and you subtract your expenses, the money that's left over would be your net income or surplus that you save. And the next item we look at, or next different document we look at in personal finance, is something called the balance sheet. And the balance sheet is used to figure out our net worth. And that's the number most wealthy people are concerned with, because the higher their net worth at the bottom here, the richer they are, or the more money that they usually have. So the balance sheet on it shows our assets, liabilities, and our net worth. And assets, the property or possession which value can be assigned, and we usually have depreciating and appreciating assets. Stock investments we usually think of as appreciating assets, whereas a vehicle we would consider a depreciating asset. So you all are going to create a hasty balance sheet and a hasty income statement. I'm not looking for tons of detailed information on there. I'm just looking to see that you know how to calculate both the income statement and the balance sheet, and that's something I'll explain further on when we get to your project. Now, one of the things when thinking about the assets that you would include in this is we look at sort of major assets, again, which a value can be assigned. For example, you might have a closet filled with old t-shirts, but ask yourself how much you could really go sell those t-shirts for. And the answer is probably not a lot of money. So assets like that, we don't want to include on a personal balance sheet, because it's not telling us anything, and we're probably not going to go sell the shirts that we own. I'm talking about just a plain old T-shirt. You're not going to go sell those and use the money to buy a new car or something like that. That'd be silly. So we're concerned with assets again that are significant, that have marketable value. If you think about a Nintendo Wii, you may want to include that in this balance sheet because that does have value. You can go on eBay, and eBay or Craigslist, or where you can find the values of those items, you can sell a Nintendo Wii for probably $50 or $75. Now, for the balance sheet that you're completing in class, you're just going to put a column in there, a row in there for other assets. So I'm not asking you to go around your house or go around wherever you live and try to add up each individual asset such as that. Well, you're just going to give me a ballpark of what you think those are worth. Now, liability, when you hear liability, if you've taken an accounting class or not taken one, liabilities is really just another term for loans. So liability is money that you owe to others. Typically, we think of bank loans, student loans, credit cards, those types of things. And when you enter that on a balance sheet, you want to go ahead and put the outstanding balance. So, for example, on my house, if I own a $100,000 house and I have a mortgage for $75,000, the amount I would want to put out there, and once I pay the $75,000, the house is paid off, it's mine in full, then the amount I owe to the bank, if I were to pay it off tomorrow, is $75,000. We're not going to incorporate the interest rate you pay the bank and try to add all that in over a period of time. On the balance sheet, we're just concerned with what it is you owe others. And typically, it's just easier mentally to think of liability, loan. They both start with an L, so any loans you have. When you subtract liabilities, or take your assets, subtract your liabilities, what's left over is your net worth. And that, again, is the important number that we look at and wealthy people really focus on. Because their goal is to increase their net worth over time. All right. Now, again, if you've taken an accounting class, things are a little different in the world of personal finance, and we actually try to simplify and make life easy for us. In a personal accounting, or a personal income statement and a personal balance sheet, assets are entered at market value. In other words, the example with the Nintendo Wii I gave before, you can go onto eBay and figure out how much you can sell it for. That's the market value. In a regular, generally accepted accounting principles in the world of accounting, at a business or something like this, you'd enter assets at a purchase value, whatever you bought them for. Then you would depreciate those over however many years. Again, in personal accounting, we're just trying to make life simple, so you enter those assets at market value. Now, the next thing that's a little different is we calculate in personal accounting, or personal accounting statements, we calculate the net worth by taking assets minus our liabilities. Again, we're just trying to make life easy for you, and that makes the most sense. Whereas in traditional accounting, organizational accounting, we would take our assets and set them equal to our liabilities plus our owner's equity, and those things would have to, in fact, balance. So assets, your total assets would have to be figured by adding all your liabilities plus your owner's equity, and we'd set those things equal to each other. So those are some of the differences. Again, in here for the balance sheet, we'll just go ahead and enter, take our assets minus our liabilities and figure out what our net worth is. Now, something I wanted to talk to all of you about in the next upcoming sections is a little bit of the difference between this class and many other personal finance classes. Most classes that are taught at SDSU are taught sort of from the academic perspective. And in those environments, academics will try to find the quantifiable best way of doing something. and they may teach multiple ways of accomplishing or doing something. Academics will also often present two sides to a story. And in here, I'll try to do that on occasion, but a lot of times I'm going to be talking as more of a guru, such as a Susie Orman or a Dave Ramsey. And the reason I do that is we don't have enough time for me to present the 25 different ways you can budget. A, it's really of no benefit for you, and B, well, I guess A and B are the same. It's not going to be of much benefit for you. So at times in here, I'm not going to speak as much as an academic, but probably more as a guru, and just to cut the time down to tell you, here's what most people recommend or most financial professionals recommend, and that may be the way of doing something. Now, typically, a good financial guru is going to incorporate probably some consumer psychology into the way they're doing things. And even though the quantifiable best way of doing something might be the academic way, a guru will say, no, we're not going to do it that way, and here's why. And in personal finance, it's usually something to do with consumer psychology. For example, Dave Ramsey, some of you may have taken a class from him, talks about using what's called a debt snowball to pay off your debts. Now, most financial professionals would tell you when you start paying off any outstanding debts, you should start with the credit card or start with a loan that has the highest interest rate and pay that one first. The reason you do that is because if you pay that off first, you will in fact pay less interest. So in the end of paying off all your debts, you'd have the most money. Dave Ramsey, however, suggests or recommends that you pay the credit card or the outstanding loan with the lowest balance first. And the reason he says to do that is because you're more likely to stick with it longer if you feel like you're accomplishing something sooner. Now, kind of interesting, even though you're going to pay out more money because you're going to be paying the lowest loan first, regardless of what the interest rate is, a Times Magazine article actually compared Dave Ramsey's suggested way of doing things versus more of the academic way to do something. And they found, as Dave Ramsey suggests, that people were more likely to follow his program than they were doing something the quantifiable best way. And that, again, is because of consumer psychology. Now we kind of get into this idea of the